Okay, hello everybody. This could be a complete disaster, but if everything's working, I'm going to be on YouTube, LinkedIn, Twitter streaming, Twitter Space, and Facebook, and we tried to plug it all together, and we probably we probably tried to be too clever. But wherever you are, you should be seeing something. And if you want to see me on video, I'm on the Simon Dixon YouTube channel or on my LinkedIn. Or there should be some kind of Twitter stream as well. But we also put the Twitter Space because after this, we're going to go straight into engagement because so much has happened this week. It's another one of those wild weeks. So here's how we're going to do this. The first part, we're going to be focusing on a little bit of background to help understand the history of the UK financial crisis and any restructuring central bank digital currencies that I think come from this, and how so all it relates to some of the company restructurings in the Chapter 11 cases. I've tried to tie it all together to make it as topical as I can. And then after this, at the end of this, we'll go over to Twitter Spaces, where we can do some engagement and we can cover the topics that you like. Okay, all right. So the UK financial crisis actually occurred this week, if you didn't notice. And it led to some emergency action from the Bank of England. So let's rewind a little bit to help us understand what happened. At the same time, there was a lot of announcements on the corporate side and the crypto side in our evolving Lehman Brothers of crypto moment. So we are having financial crisis both in the traditional markets and the crypto markets. And I'm going to try and tie it all together and hopefully put together some forecasts so you can be prepared for what comes next. All right. So as always, what I'm famous for is doing a little bit of history. Whenever I try and predict the future, I always go back into similar situations in history to try and help us find out what happened in the past. And this one goes all the way back to Nathan Rothschild and the bond market. So the creation of the bond market was really popularized by Nathan Rothschild. And there's so many conspiracy theories about the Rothschilds purely because they became, and Nathan Rothschild became the largest broker and the family of bonds, which meant that the bonds that they were pushing often dictated the future of the outcomes of wars. And so the famous example was in the Battle of Waterloo during the Napoleonic Wars, when Nathan Rothschild decided that they were going to back the Brits, which relates to the current financial crisis, and the creation of gilts, which are long-term bonds. They later became known as gilts, which is the long-term bonds in the UK in order to fund the government in a time when they couldn't collect tax because no one wanted to fund those wars. And so therefore you had and needed the bond market. And the broker that could push the most bonds was the one that really determined the outcome of wars. And that was what made the Rothschild famous, family famous for pushing out those bonds. And really that came to the 1860 American Civil War. And during the American Civil War, Nathan Rothschild and the Rothschild family reached a stage where they made more money out of not funding wars and having peace, because they switched from pushing bonds to becoming portfolio managers. And as one of the largest holders in their portfolio of all these different country bonds, it made it more profitable to maintain the status quo. So what I always talk about in things like Retirement Plan B is the concept of building and protecting your wealth. When you're at the building stage, you tend to get a bit more speculative. And if you have some of those bets, you move over to the protection stage. And the protection stage is where it's all about wealth preservation. So an example would be people might be more prone to investing in Bitcoin as a store of value because of its more speculative nature. But once you've got vast wealth, you tend to switch over to something more conservative like gold, which is not meant to make you wealthy, is meant to preserve your wealth. And so the Rothschild went from pushing bonds, which was the war was the best way of pushing bonds, to holding them in a portfolio, in which case you were more into peace. And so really this is where in the Napoleonic Wars that happened, but in the American Civil War, the Rothschilds decided to sit out. And so they had to find a different type of bond in order to fund the American Civil War. So it was the South versus the North. The South went to Rothschild, the House of Rothschild, and they declined to invest in those bonds because they didn't want such division in America. And so they couldn't really sell those bonds without the House of Rothschild. And the bond is just simply a way of funding a large-scale infrastructure projects, whether it's corporate, it's a debt instrument that can be bought and sold on a market, just like a stock market. And it guarantees a fixed interest. And it's really backed normally by the credit rating of a government or the company that's issuing it. And it's one of the reasons why many companies go public on the stock market. For example, mining companies, they like to go public on the stock market because mining is such a capital-intensive infrastructure that you can raise debt by selling junk bonds, they're called, or corporate bonds, by using almost your stock as collateral on the public market. So you can have both debt and equity. And once you are a public company, you get open up to many of these debt markets. So let's go back to the American Civil War. Well, the South needed to find a new way to fund these bonds, and they created something really innovative. And that was they took the commodity that they produced the most in America, in the southern part of America. I don't mean South America, but the southern part of Northern America, as it were. And that was cotton. And they created a bond that was backed by cotton. And the way it worked is that if they did not repay that coupon, because it pays a fixed interest rate, then you could use the cotton as collateral in order to take that and back the bond. And because cotton, they were able to restrict the supply of cotton, it became a really, really popular bond. And cotton prices soared when they restricted the supply in order to try and manipulate, essentially, the funding that they could get in order to fund the next phase of the American Civil War. Interestingly, the biggest importer of cotton that America was importing to was the UK. Approximately 80% went to the UK because of the British Empire. I'm just going to get my phone off. Too much technology happening at the same time. Okay, and hopefully that. But because when they restricted the supply, it actually created a recession in the UK and caused mass problems in the UK. And this really allowed people to invest more in America to fund the war and cause big problems in the UK. So think about that example when we fast forward to today. Now, what actually changed that was the dynamics of the fixed supply of. So, scarcity is what causes the increase in these prices. But new cotton, as a result of this, was actually found in China, in India, and Egypt, and it pretty much flooded the market with cotton. And because the supply of the collateral could be increased, those bonds, the prices crashed, and they couldn't get the funding. And then they had to do pretty much what the UK is doing right now. When the price of those bonds crash, they had to counter it with money printing. Now, it's a slightly different mechanism to what happened today, but essentially, those bonds and governments, in America, they had the greenback and the grayback, and the South printed up about $1.5 billion. And that flooded the market because the bonds were useless and it went into a speculative frenzy. And the North then countered that with the greenback. Now, what this was, it was money printing directly from the government. Today, we call that modern monetary theory. In my book, Bank to the Future, Protect Your Future Before Governments Go Bust, I talked about the inevitable consequence of a debt-based Ponzi scheme is that you end up having excessive money printing, and then that causes problems when you try to monetize it. And the end of the Ponzi scheme is when you start getting downgrades in the credit rating and no one's willing to buy those bonds. And so therefore the government steps in, or the central bank steps in and needs to make up for that money printing. If you do it through the central bank, then you simply fire up some digital money and you buy some of those government bonds to make up for the decrease in the supply. and the end of that, or you can actually just have the government deleveraging and printing the money direct, which is what they did in the case of the greenback, but it led to massive inflation. And so if you look at the two separations during the American Civil War, the greenback, which was printed in the North and it had more control over it, it ended up at about 50 cents on the dollar by the end of the Civil War. However, the grayback, which was as a result of mass printing in order to combat the bonds that were created in the South, the cotton-backed bonds, when the cotton supply increased, it went to about 1 cent on the dollar. You had about 4,000% inflation, hyperinflation in South during the Civil War, but you only had about 60% in the North, and that determined the outcome of the war. When bonds failed, you moved to excessive money printing, and it's the outcome of the inflation that determines what happens next. So let's try and fast forward that to where we are today. Hyperinflation is normally the consequence. And so the big challenge that we have in today's economy is that the UK government last Friday, when the government switched, they decided that they wanted to move the market more towards free market economy. Now, this is really interesting because the free markets just don't exist. We've moved over to markets that aren't allowed to crash. And when they crash, you solve inflation with more inflation by printing more money or creating more money in order to solve an inflation problem. If you go back, if you believe in Austrian economics believes that you have to have hard money backing the system. Chicago economics believes that inflation is always a monetary concept, and so you solve it through central banking and increases and decreases in the money supply. And Keynesian economics believes that in these tough times, the government has to step in, and then you have to repay that government debt during the good times, but they never can because it's a debt-based Ponzi scheme where if you pay down the debt, the money supply decreases, and that causes deflation, a willingness to correct the market. So the UK government decided to do something, which is try and get a step towards free markets during one of the worst markets in history, proving that it's an absolute disaster when you try and move because of the way that the monetary system is structured. So we're at the end of a debt cycle. We're having really, really dire inflation. We're having the supply side shocks from, the sanctions, essentially. And one side will say it's because of oil. The other side will say it's because of sanctions. But we're in this the experiment of having money where you're increasing the supply, money that you can't own, and money that you can't spend as a result of anti-money laundering, sanctions, money printing, quantitative easing, and everything that the market is moving towards. So when the UK decided that they're going to create essentially Big Bang 2.0, Big Bang was the time when we were transitioning from a physical stock market to a digital stock market. And during that time, there was a real appetite towards deregulation during the Thatcherite Prime Minister and the Reagan presidency, and really just a deregulation of the financial markets. And the removal of things like the Glass-Steagall Act, where you separate retail banking from investment banking so that the more speculative side is separated from the part that's funded by insurance deposits. And so this was, what we have seen this week in the UK is what happens in the TradFi market when the government tries to intervene and move towards tax decreases, deregulation, during a time when the Bank of England is trying to combat inflation with more inflation and an appetite and a need to send a lot of people that own real estate and property bankrupt by putting interest rates up to 6% because they borrowed it at the low interest rates. And you had the worst of all worlds, a transition trying to get to more free market economics, Big Bang 2.0, at the same time as a cost of living crisis, inflation, excessive government spending, and a Bank of England that's not following the same policy as the government. And so in the end, the government had to step in. So you had this market where you had a reaction to the market that caused a crash in the British pound. The British pound seems to be moving towards parity with the dollar. The dollar has been strengthening against everything else. This started to affect the pensions that are the big investors in government debt. And so when they want to, they consider the government more risky. And rather than having a credit rating downgrade, the pensions decided that they need to sell off some of those long-term gilts. They're not beating inflation. It doesn't make sense as a financial product anymore. And now it's becoming increasingly risky with the excessive debts that the governments are running at the moment. And so therefore they started selling those down. And as the pensioners started selling those down, the collateral in those pensions that they rely upon in order to pay out the pensioners started to have a run on the UK pension system. The prices started getting worse. The Bank of England needed to step in and essentially remove away from quantitative tightening right back to quantitative easing. And this was as predictable as day, not this exact event, but it was predictable that anytime you move to quantitative tightening, you end up having to spring right back to quantitative easing, simply because of all the exposure in the debt-based Ponzi scheme with all these large pockets of debt, like the credit card debt, the pension crisis, and various other things. And so we saw it in real time, and the Bank of England essentially saved the pension system from disaster. But we have essentially, what have we done? We've rolled up the government debt, and we've taken on that onto the Bank of England's balance sheet. And so essentially you've got the debt of the government that was trying to get their debt in control. And instead of putting it on the pensions balance sheet, you put it over to the Bank of England's balance sheet as the Bank of England grows and essentially ends up owning the government. And that is the trend that we're seeing, these growing in the balance sheets of the central banks, ready for the test pilots of central bank digital currencies. So when you're gradually pushing all these assets through the debt-based Ponzi scheme, where there's not enough money to pay the debt, and if you pay the debt, it causes a crash in the economy because it contracts the money supply, you end up start looking at how do you increase the money supply without increasing the debt. And that's where central bank digital currencies come in. I predict it's not going to be central bank digital currencies, it's actually going to be government digital currencies. So just like the American Civil War, which was funded, the winning side did it by the greenback, and the greyback caused a big run because of the bond speculation. I think you're going to see that happen more on the government side. And so at the same time, we've started to see these experiments where the Bank of International Settlements has been testing their central bank digital currency between the Middle East and the Far East, and no dollars in the middle. And so as a result of many of these geopolitical sanctions, you're starting to see a hyper-acceleration in the rate of trying to figure out how you transact without SWIFT and without dollar in the middle. And so the Bank of England came in and said, we'll put $65 billion, we'll purchase $65 billion of these bonds on an emergency action in order to bail out the pension system and roll over the system further, ready for the issuance of central bank digital currencies, which is the only, the only trump card that governments have left right now, which is a slow removal of freedom when you're trying to protect a far movement to left-led socialist styles of economies. And when you try and move back to right free markets, you end up blowing everything up because of the severe over-leveraging. So you have to figure out a way of deleveraging, which is just issuing the currency direct, waiting for banks to go bust, and raging war on the banking system. Okay, so pretty scary stuff that we saw there, but we're starting to see some of these trends from Big Bang 2.0 and recognizing that the inevitability and predictability of fiat debt-based currencies is a slow transition from a free market based upon hard money and Austrian economics, to more socialist Keynesian style of economics. And at the extremes, you print the central bank digital currency and slowly transition to a more communistic modern monetary theory style of organizing economies, which is a slow transition. You see in the fiat currency the importance of the inevitability, predictability, and guarantee that that's where the debt-based Ponzi scheme takes us slowly. And those get normally destroyed by inflation and a desire to move back to hard money. So as individuals, either self-opt into hard money, either through Bitcoin, digital hard sound money, or gold as the traditional pension funds. You get either a monetary renegotiation where the governments, and that normally happens only at the end of wars, you get that monetary renegotiation, or you get a voluntary opt-in into hard money and a reset of the system into whatever the new standard is. The importance of having Austrian free market money at the same time as pushing into these trends. Okay, so that's what we saw in terms of the macro. Again, it's a slow transition over central bank digital currencies as the final trump card to bail out the system. Right, what else have I got in my notes? So we've got central banks buying. Okay, we got through all of that. Let's move over to what we've been seeing on the restructuring in the crypto markets and the centralized companies in Chapter 11. So this was a huge week on the Chapter 11 side. We started to see one of the companies in Chapter 11, Voyager, elect to use, rather than a company reorganization and some free market solutions, going through an auction process, which is another free market solution, where essentially, rather than issuing equity and debt instruments like we did with Bitfinex, putting it through an auction whereby other companies can come along and purchase those assets to try and fill the hole. Now, the reason that this worked, I did a 9-part tweet on Twitter, and we'll go over to the space in a bit where we can answer more questions on it. But the reason that it worked is because the hole in Voyager is a little bit smaller. However, you start to attract some of those. It was framed as a $1.4 billion purchase. But approximately $1.3 billion of that was actually just the coin. So you don't pay a premium for cash. You're buying them at the bottom of the market, so you just don't really consider the cash side of it. So the end offer was 111 million, and it was structured in a way really where half of that is going to paying the fees, the other half might feel a minuscule part of the whole. Because it was done via an auction, the value transitioned over from the creditors to the shareholders that made the purchase. And so essentially, it's transitioning that value. The reason that those companies like FTX is making the purchase is because they want that value for their shareholders. So they purchase the assets and their shareholders get to benefit from that. Whereas with the Bitfinex situation, it was about using IOU tokens convertible into equity so that those that were affected by this, the creditors, ended up with the benefit of all the assets and they became the shareholders, which is how you do it if you want a long-term relationship with those customers. Now, it looks like because FTX acquired it, they just want to take everything over to their platform, so they don't really care too much. But I think if you want a long-term relationship, you figure out a strategy of how to make those creditors whole. We'll see whether that happens, but it looks like that hasn't happened and the benefit goes over to those shareholders. And that's what we call a vulture offer in the current market. At the same time, in the Celsius side, we're moving over to that auction process. Now, the difference here is we have, a $2 to $3 billion hole as crypto crashes. Because Celsius is crypto short, that hole gets smaller if you wanted to just simply purchase the crypto assets. But at the same time, the value that you're willing to pay for those assets decreases as well, because the value of those assets decrease. Let me just grab some water quickly. So let's tie this together. For example, let's go back to the traditional markets and the pension. I gave in 2013 Boris Johnson a strategy for how to issue a Bitcoin-based bond similar to the cotton-backed bond, and implement a Bitcoin strategy, which obviously it was too early, too speculative, but Bitcoin was about $300 at the time. In the end, we ended up backing it by Bitcoin mining in Iceland, and we did it through the private markets, and we created the first Bitcoin-backed bond in 2014, which entered into many of our Bank to the Future clients' retirement plans as well, and was one of the highest performing products within that, and it dwarfed any of their traditional pension in terms of returns. In El Salvador, they're looking at the same thing. So President Bukele inherited a bunch of debt from civil wars and many wars and tough times in governments of the past. But throughout 2024, 23 and 24, we can look at a Bitcoin-backed bond in order to use hard money in order to restructure a percentage of the fiat currency. And if you can't repay in the fiat currency, it can be backed in the collateral. But what's the difference between cotton and Bitcoin? Cotton, you can always go and find a new supply. Bitcoin, you can't. It's why, the different crypto assets are very different. You can print crypto assets just like you can print the greenback, just like you can print stocks and shares as a security. But with Bitcoin, you can't change that supply. So that, kind of changes it. So let's look at what's happening in the Celsius situation. The Celsius situation is there's lots and lots of assets that have been, accumulated over time using, essentially it was illegal, as the UCC confirmed recently on the town hall. And we've been confirming all along, but it was great to get that confirmation so that we can become more unified. They illegally purchased a bunch of assets using our money without having the licenses or the disclosures in order to do that. So there's a bunch of assets that sit there. Now, when you move into the auction process, a bunch of people are going to come along and say, well, we'd like those assets to come to our shareholders. So we'll put together a bid for those assets. And guess who's coming along? FTX. So FTX now owns BlockFi. They got a $4 billion company for 25 million and up to 250 million if they get all the regulations and the SEC side covered. They also ended up buying Voyager by giving them a line of credit through some of the restructuring of the loans that they already had. So it was kind of like a restructuring here. And then they used that in order to win the auction and get all those assets. And now they're going out and they're raising $1 billion so that they can try and get some of the Celsius assets for the cheap. And so that is the approach of taking those assets, taking advantage of the market and giving the value to those shareholders. So FTX will be pitching those shareholders and they're saying, we'll invest $1 billion. We think your company's worth $32 billion. And if you can get some of those distressed assets, then we as shareholders can benefit from that. And FTX can own both the BlockFi to get the regulatory side sorted, Voyager to get some of those customers sorted, and then try and get a bunch of the Celsius assets. And so what we want to try and do in this scenario is make sure, and I'm really happy because I came on a space this morning with many of the real diehard Celsius community, and we started to reach an alignment around the best approach because some changes were made in management this week, and the bid process was announced so that we could start talking more about how we can really utilize those assets for the benefit of creditors rather than ending up them being the benefit of some of those that want to take it over to their shareholdings. And so really this brings us full circle into where we are right now. And that is that new innovation exists. And there's only really 3 ways of taking any of these situations and restructuring. And the way that you restructure it is just simply who's going to benefit from it. And so if you take a bunch of the government's debt and you bail out the pension scheme and you put that on the central bank's balance sheet, then they have leverage over the government, because the government, if they issue theirs direct, is debt-free. But if the central bank buys it, then the government, the debtor is the one that owns the government, and then they can issue the central bank digital currency rather than the government realizing that they could issue it without the debt direct. The same with the Voyager situation. FTX acquires, they use debt in order to give them a line of credit, same with BlockFi. And so rather than them having to go into Chapter 11, they got to acquire it, and the customers just continue the relationship as usual. With Voyager, the creditors pay and the shareholders in FTX benefit. And with Celsius, the same approach is trying to be used, but the difference here is that if we can combine those key assets with the lending regulations and the securities regulations, then this time we might be able to do a compliant version of what we did with Bitfinex, which is take debt, equity, and entitlement to the benefits of those assets, combine it together in a way where regulators sign off on that, and then that competes with the offers that are going to be coming through those that want to take all those assets and give it to their shareholders. And so really the alignment now is that doing a reorganization that gets regulators to be able to sign off on it, so that essentially you could package those assets to the benefit of creditors. You could make that convertible into the equity of a valuable company, and you can use an IOU instrument in order to give people the more liquidity that they need. And all you need to do is figure out the right combination of packaging those together. And if the stars and the moons all line up and regulators say yes, we can create a reorganization just like we did for Bitfinex, and the creditors get all the benefit rather than having new shareholders get all of that benefit. So with that in mind, I know that was a lot, and there's a lot happening right now. Excuse me, my voice is going as well. I'm going to grab some water. I'm going to end my stream on YouTube, or I think it's going to continue throughout the Twitter space. I can't get my head around what's happening. It will probably continue on all the different, but I'm going to switch my camera off, and I think Azad's going to move over to a screen share. And everyone needs to now come over to Twitter Spaces. So if you don't have a Twitter account, head over to Twitter Spaces at Simon Dixon Twit. The link will be in the description or the live, wherever you are, wherever you may be. And then we can engage and we can go through more detail, answer your questions, and head over there. So I'm going to end the YouTube, and I'll see you over on Twitter Spaces shortly.